Tonight, I want you to picture something that feels wrong deep in your bones. You walk into a grocery store. The shelves are empty. No rice, no milk, no bread. That's bad, but at least it makes sense. Shortage equals empty shelves. Now picture a second scene, one that's much darker. A truck backs up to the loading dock. The doors roll open. It's full. Pallets stacked to the ceiling. And the manager steps forward and says, "I'm not selling you anything, and I'm not buying anything either." In a living economy, someone is always buying. Someone is always selling. Usually both. That back and forth is the heartbeat of a market. When that heartbeat stops, the problem isn't tight supply. The problem is that the market's brain has glitched. And that glitch has just shown up inside the US physical silver pipeline in a way I've never seen presented this bluntly before. Because the most disturbing thing on my screen wasn't a price candle, it wasn't a viral tweet, it wasn't even a dramatic headline. It was a plain, boring trade sheet from a top-tier wholesale distributor, the layer that sits between refiners and the dealers you actually talk to. One sheet, 2 columns, and a message that screams louder than any chart. The sell side reads like a cemetery. Eagle's gone, Maple's gone, Standard Bar's gone, bulk round's gone. You expected that part. Everyone watching silver expected that part. But the buy side is where reality starts bending. Multiple items are stamped with a phrase that should not exist when demand is roaring. No bid, not low bid, not we'll offer under spot. No bid, as in we are not quoting, we are not buying, we are not taking your call. So before we talk about charts, targets, or fantasies, we have to ask a painfully simple question. How can a market be sold out and still refuse to bid on the same metal? How can the pipeline say we have nothing for sale while also saying we're not buying your supply? That's not normal. That's not a hiccup. That's a system message. And the system message is this. The issue is no longer demand. The issue is funding. Now let's slow this down and make it make sense. People hear no bid and assume it means the metal isn't wanted. In stressed markets, it often means the exact opposite. No bid is what happens when the buyer is willing, but the buyer's cash is missing. It's a liquidity failure. Liquidity is the invisible oxygen of markets. You don't notice it when it's there. You panic when it's gone. Here's the ugly truth. The wholesale layer of the bullion industry is not built like a vault. It's built like a conveyor belt. These companies don't behave like long-term investors. They behave like logistics firms. They buy metal. They hedge the price risk. They ship it. They repeat. They make money on spread and volume, not on price appreciation. Their margins are thin. Their balance sheets are large. Their survival depends on credit lines staying open. So when silver goes vertical, the metal becomes more valuable, but the business becomes more fragile. That's the paradox you're seeing on that sheet. Sold out on the sell side because product is hard to source. No bid on the buy side because they can't finance the flow. If you want a simple analogy, a taxi company can have passengers begging for rides, but if it can't buy fuel, the cars don't move. Demand doesn't matter if the machine can't run. Now comes the question that sounds like a riddle. How do dealers struggle in a bull market? How does a business selling silver get stressed when silver is ripping higher? This is where the modern system turns cruel, and the answer is hedging. Most large dealers are not allowed, by lenders, by policy, by risk managers, to hold inventory unhedged. Why? Because price can fall between the moment they buy and the moment they sell. A few dollars down on millions of ounces can erase an entire year of profit. So the standard practice is simple. In theory, buy physical. Short paper. If price falls, physical loses value, but the short gains. Losses offset. The business stays stable, that's the theory. But the market doesn't care about theory. When price rises, especially fast, the short bleeds. And that bleeding demands cash every single day. This is the part most people miss. The gain on physical inventory is mostly unrealized until you sell it. It's a number on a spreadsheet. The loss on the short is real immediately. Every day, the exchange marks the short to market and demands variation margin. Real dollars, wired on time, no excuses. So you can be massively up on inventory while being forced to pay massive cash on the hedge. And if you don't have that cash, you're not stressed. You're finished. That's how a rising price can kill a dealer. You might be thinking, can't they just sell the physical and close the hedge? In calm conditions, yes. In violent conditions, not always. Inventory can be tied up in transit, allocations, delays. And even if you sell, the cash might arrive after the margin deadline. The exchange doesn't wait for your shipping schedule, so the hedge that was meant to protect the business becomes a cash vacuum. And once the cash drains, one sentence changes everything. No bid. Because if you can't write checks, you can't buy metal from the public, no matter how strong demand is. Now make this even more real. Think about a small coin shop. They buy from the public. They sell to customers. And when they need to restore cash, they sell to a wholesaler. The wholesaler is the backstop, the exit door. When that backstop stops bidding, the small shop's risk explodes. If they buy your silver today, can they sell it tomorrow? If the answer becomes maybe, behavior changes fast. Spreads widen, buy prices drop, purchasing slows, or buying stops entirely. That's how the no-bid disease spreads down the chain. It starts with banks, hits wholesalers, infects retailers, then reaches you. This is why this isn't just a price story. It's an infrastructure story. And infrastructure stories change behavior fast. Now let's add another layer. Banks hate volatility. To you, silver ripping higher looks like strength. To a bank risk officer, it looks like danger. When volatility rises, banks increase haircuts. They lend less against the same collateral, even if it's worth more. And there's a simpler math problem. Credit lines are usually fixed. A $100 million line funds a lot of ounces at $25. At $95, that same line funds far fewer ounces. So as price rises, the pipe shrinks, pressure increases, then the pipe cracks. That's how the wholesale layer can look busy on the outside while choking internally. Now here's the cliffhanger. If one major distributor is marking no bid, the question isn't whether this is real. Now the question is, how many are next? These firms share the same lenders, the same hedging venues, the same funding structures. Stress rarely stays contained. So what do you watch? Delivery times? Buyback quotes? How quickly simple price questions stop getting simple answers? Watch the language shift from "we can get that" to "we'll call you" to "we're not quoting right now." If you're seeing that locally, take note. Have spreads widened? Have shops gone cash only? Have buybacks paused or been limited? Local observations are often the earliest warning system. Now let's confront the narrative trap. When the media sees no bid, they'll say, "See, nobody wants silver." That's a plumbing error. When liquidity breaks, transactions fail. Failed transactions can look like weak demand to people who don't understand systems. Demand isn't the problem. Funding and clearance are. It's the difference between hunger and payment. A restaurant can be packed. If the card machines are down and there's no cash drawer, nothing moves. The food is still wanted, the mechanism is broken. And that leads to a more uncomfortable implication. If official buyback pathways become unreliable, converting silver into dollars through standard routes becomes less predictable. That doesn't make silver less valuable. It makes it more monetary. Valuable, but not always liquid through corporate middlemen. And when middlemen fail, markets route around the damage. Peer-to-peer, private, local, history returns. For thousands of years, silver didn't need wholesalers or paper exchanges to have a price. Price was discovered between humans, not algorithms. When paper systems strain, that older system wakes up. Now we have a two-price problem forming. There's the screen price, and there's the street price. The screen price is printed by paper markets. The street price is what someone will actually pay for real metal under stress. When supply chains seize and competition shrinks, street price can rise faster because it includes a trust premium, the cost of certainty. And when wholesale trust cracks, that premium grows. Add consolidation. In every crisis, small operators get squeezed. Local shops run on cash flow. When recycling and financing become uncertain, they go defensive. Fewer shops means less competition. Less competition means wider spreads, higher premiums, lower buy offers. Liquidity worsens even as the asset becomes more valuable. That's not a contradiction. That's stress. Now think about recycling. Metal returns to market through people selling, estates, old stacks, silverware. That flow depends on dealers buying. If buybacks slow, recycling dries up. One pressure valve disappears. Scarcity becomes structural. When scarcity becomes structural, people stop selling. Velocity drops, small demand pushes price harder, acceleration begins, and acceleration breaks weak structures. That trade sheet wasn't the end of the story. It was the first visible crack. So here's a question that matters. If you walked into your local dealer tomorrow and they said, "We're not buying today," what would you do? Hold? Search elsewhere? Go private? Panic? The people who decide before the moment stay calm in the moment. And here's the deeper question. Is the real price of silver what's on a screen, or what you can actually trade it for where you live? Those answers reveal how you're thinking about the world ahead, because the next risk is bigger. A paper-physical divergence so wide that headline prices become almost meaningless for real metal. That happens when paper clears without metal, when settlement becomes cash, when physical is rationed, when premiums become their own market. I'm not saying that's universal today. I'm saying the conditions that create it are now visible, and that deserves attention. Because this isn't just bullish or bearish, it's destabilizing. And destabilization creates opportunity for those holding real, unencumbered metal, and danger for anyone relying on leverage, promises, or instant liquidity. In stressed markets, price is secondary. Access and optionality are primary. And the people who understand that don't need reassurance when systems wobble. They've already prepared. When a system comes under stress, it follows a familiar sequence. First, it denies, then it blames, then it tightens, then it adapts. We may already be in the tightening phase. An adaptation is where a new market quietly forms. So now let's talk about the hidden engine behind that adaptation, because it isn't price, it's trust. Trust is what makes a bid exist. A bid isn't just a number on a screen, it's a promise. It says, I can pay you. When credit freezes and margin drains cash, that promise weakens. And when trust weakens, bids disappear. So if you're watching this and thinking the real story is silver going to some headline number, you're missing what actually matters. The deeper story is that trust in the market's clearing mechanism is starting to fracture. That's why this moment is bigger than a chart. Now, let's talk about the last mental shift that matters for anyone paying attention. First, understand that what you're watching is a squeeze driven by plumbing, not popularity. Second, understand that official channels can become slow, selective, or unreliable, even while the underlying asset remains strong. Third, understand that in moments like this, the best information doesn't come from headlines. It comes from the ground. What are you actually seeing? Are online dealers delaying shipments? Are local shops limiting quantities? Are buyback quotes shifting faster than spot prices? Are premiums behaving in ways that feel disconnected from logic? Those details matter more than commentary. Write them down. Patterns emerge before narratives do. Now here's the closing cliffhanger that matters. A wholesale no bid is not a final state. It's a snapshot of stress. Stress forces decisions, and the decisions the industry makes next will shape what the silver market looks like on the other side of this. Will credit expand to stabilize the system? Will consolidation leave only a few dominant players standing? Will paper prices and physical clearing prices permanently diverge? Will private trade networks quietly replace parts of the traditional system? One of those outcomes is already starting, and the first clue was on that sheet. Sold out. No bid. Two phrases that don't belong together unless something has snapped. Now let's do something. Most commentary avoids, because it forces you to think like a wholesaler instead of a spectator. Walk through the cash math. Imagine a mid-sized distributor carrying 2 million ounces of silver as working inventory, not as a bet, as stock meant to move out to dealers over the next few weeks. At $25 an ounce, that inventory is worth $50 million. At $95 an ounce, it's worth $190 million. From the outside, it looks like a windfall. It looks like instant wealth. But the wholesaler doesn't own that inventory the way you own metal in a safe. They finance it. They borrow to carry it because volume requires capital and turnover requires credit. So there's a credit line. Maybe $80 million, maybe $120 million. The number varies, but the structure doesn't. There's a ceiling, and the business constantly operates near it. When silver was cheap, that ceiling was enough. When silver reprices upward fast, that ceiling becomes a choke collar. And it gets worse when lenders change terms mid-game. Banks don't lend against the full face value of inventory. They apply haircuts. They lend less than it's worth because they fear a sudden price drop before collateral can be seized and liquidated. In calm markets, the haircut is modest. In stressed markets, it grows, so the inventory looks bigger, but the usable capital shrinks. That's how a balance sheet can expand while the business feels poor. Now layer the hedge on top. The wholesaler buys physical and shorts futures to stay price neutral. That short requires margin. The margin is paid in dollars, not ounces. When silver rises sharply, two pressures hit at once. First, the credit line funds fewer ounces, collapsing buying capacity. Second, margin calls increase, draining cash daily. It's like being told to run faster while your lungs get smaller. Here's the killer detail. Margin doesn't care that you have metal. It only cares that you have cash. And cash is the first thing to disappear. So what does the wholesaler do when cash tightens? They stop taking new risk. They stop bidding aggressively. They stop buying from the public. In extreme moments, they mark no bid simply to preserve oxygen. That doesn't mean they've turned bearish on silver. It means they're trying to survive a plumbing failure. Now here's the part that confuses people. If demand is overwhelming, why not buy and flip instantly? Because nothing flips instantly when the downstream is also stressed. Dealers may lack cash. Shipments may be delayed. Hedges may demand margin before customers pay. Banks may slow settlement. In calm times, those timing mismatches are minor. In stress times, they're fatal. A wholesaler can buy today, expect to sell tomorrow, and still fail if the cash cycle doesn't line up with the margin cycle. What looks like free profit on paper becomes cash death in reality. That's why serious markets care more about liquidity than headlines. Now look at the next domino, the retail dealer. When the wholesaler goes defensive, the retailer has to choose between serving customers and protecting the business. That's when behavior starts to feel irrational if you only watch the screen. Premiums rise. Purchase limits shrink. Shipping estimates stretch. Buyback prices lag reality. Spreads widen until they feel uncomfortable. But this isn't theft. It's repricing risk. If a dealer isn't sure they can restock next week, they raise premiums today. If a dealer isn't sure their wholesaler will bid tomorrow, they lower buy prices today. If delivery is uncertain, the spread becomes insurance. That's survival, not greed. Now here's the part most people don't expect. When spreads widen and buybacks weaken, selling pressure can actually fall. People look at the offer and decide not to sell at all. Metal stays private. Recycling dries up. Supply tightens further. That creates a feedback loop. And once feedback loops start feeding themselves, markets move in ways that shock everyone. So here's a simple timeline to watch for. First come delays and excuses, then limits and rationing, then widening spreads, then selective buybacks, then silence. If your area jumps quickly through those phases, the stress is real. Now, a practical point that matters. Don't wait until you need liquidity to learn how liquidity works. Know which products sell easily. Know which dealers remain active under stress. Understand verification methods. Understand timing. Treat paper quotes like weather reports, not like solid ground. They describe conditions, not footing. And even if you never plan to use it, understand how peer-to-peer trade works. Because when middle layers strain, peer-to-peer becomes a pressure valve. But don't romanticize it. Private trade brings opportunity and risk. Scams thrive where fear meets urgency. Rushed deals, refusal of verification, and artificial pressure are warning signs, not opportunities. Now zoom out again. This moment is also a message about the dollar system, not philosophically, but mechanically. The dollar clears margin, funds inventory, settles trades. When the cost of capital rises or credit tightens, real assets become harder to finance, even as they become more desirable. That's how you end up in a world where everyone wants something and nobody can move it efficiently. And here's a common misunderstanding. Dealer stress does not automatically mean falling prices. It can create short-term distortions, yes, but it can also break recycling and distribution in ways that intensify long-term scarcity. The correct mindset isn't bullish or bearish. Its volatility increases when plumbing breaks, and volatility punishes people who confuse short-term trades with long-term positioning. If you hold silver, what you really hold is optionality. The option to convert into goods, assets, or cash when conditions favor you. Optionality feels boring in calm markets. In stressed markets, it becomes powerful, but only if you understand the channels. Now tighten the lens one last time. If wholesalers remain stressed, the next signal shows up in borrowing costs and lease rates. If those rise, hedging costs rise. If hedging costs rise, premiums rise. If premiums rise, flow slows. If flow slows, scarcity tightens. And suddenly the words sold out and no bid stop looking contradictory. They start looking diagnostic. Because brittle systems don't fail slowly. They fail suddenly. So watch the plumbing, watch the credit, watch the spreads, watch the language dealers use. Because language shifts before behavior breaks. And the moment those two phrases appear together, sold out and no bid, you're no longer watching a normal market. You're watching stress reveal itself.